Il Palazzo is back on track after the steady performance decline experienced in the previous years. The new management team is composed of Vishnu and Carlotta in revenue, Justine and Mariavittoria in marketing and advertising, and Charach in facilities and refurbishment. Did a great job in saving the Palazzo. When the team took over Il Palazzo, the overall occupancy was 54%, ADR of $160, and 70% of GOP. The hotel did not have enough capital for refurnishment and investments. The team's main objective is to build up a new hotel with more services for our guests while increasing profits. After a long meeting, we decided to focus more on large groups, premium standards, bar standards, and discounted guaranteed, as they are the majority of the hotel's occupancy mix in the previous years. Regarding pricing strategy, the goal is to use a penetration strategy. Lower prices than the competitors does not necessarily means less profits. We try to steal the most from our competition, especially for our target market segments.
So, in January, we based the rates according to last year's net room rates. The focus was to maximize occupancy. Hence, rates were in the maximum occupancy rates table. For larger groups, as we wanted them to be our main guests, we decided to lower a bit the rates as we used previously, and we achieved a 10.57% of market share on our first month. For segments, we did not wish to target them, and thus the price was set very high to avoid them and to attract more of the other guests. As channel demand was expected to follow the same pattern as last year, we adopted also a similar strategy. However, considering the channel distribution costs, the percentages were altered a bit so that we didn't lose money to GDS and OTAs. Our main focus was to get as many direct bookings as possible, since it had the lowest distribution costs, which were kept at $10 per room, compared to 10% and 35% for OTAs and GDS. 100% direct to attract the most bookings. Our decision did not change over the year. However, since in the initial months, demand was expected to be low, we kept the rate reduction for larger target segments at 5% for weekdays and 10% for weekends, as demand on weekends was projected to be lower and harder to attract since it was off-season. For February and March, we kept the prices for the bar standard, we decreased them a bit, and trying to attract less than 10% of the market. Thus, we wanted to attract more guests and capture the market, so we decreased the prices. So thanks to the EPA recertification event we got in March, El Plaza started to make a profit. The MAR proposed to the group was $108. This we calculated by taking our group rates for the large group and lowering it slightly to attract the group because we wanted to maximize our occupancy for March. However, we need to increase occupancy to start making profits. We made an error in the rates as we should have lowered the bar premium and guaranteed for the weekends to maximize occupancy, but we forgot to do that. We implemented this in the next coming months.
In the first 2 months, Il Palazzo had a negative profit. The hotel had a lot of facilities and refurbishments, and we focused on marketing. Our target was to capture the group in March, which is still a low season period. We were successful in doing so. Even though the MRR was low, our RevPAR did not fall since we raised prices on the other segment, but we were still competitive. However, our ADR decreased a bit as expected.
As previously mentioned from my colleagues, for the first month of operation, our marketing focused on performance benchmarking services to keep track of our operating results compared to other hotels in the area, to see where changes and improvements needed to be made. Additionally, we initiated a hotel's website with e-commerce service in order to be listed on OTAs and search engines. For advertising, we used 5% of our total revenue, as was suggested in the guidelines, and focused mostly on OTAs because we wanted to reach out to a wider range of customers as the hotel was newly reopened.
In March, we added public relation agencies in order to reach out to the local customers and guest response services in order to improve the performance and experience in the hotel based on customer feedback. We decided to not focus all of our spending on marketing because in the first quarter of the previous year, regional travel and tourism marketing initiatives didn't impact the market until the second quarter. By the end of the quarter, we started to decrease our spending on OTA's advertising and increase the spending on direct, always keeping the ratio between weekdays and weekends.
So, beginning with the second quarter, our goal was to still keep occupancy after our RFP, and we managed to do that. We decreased prices slightly but remained competitive, marginally lower than the competition, staying in the maximum occupancy rates table. Profit decreased, but this was expected as we didn't have the group anymore. Moreover, we had 25 rooms out of order. However, this is when we identified the problem with our channel distribution and our marketing strategies not coinciding. We made the change and adjusted and increased marketing expenses to match our channel distribution. In May, we could already see the results of this. We didn't alter the prices very much since we didn't expect much change in the market. Moreover, we were entering the high demand season. Thus, with our adjustment in the marketing strategy, we wanted to see how it would react to our pricing. The impact was positive. GOP increased and so did occupancy and RevPAR. We did not have the RFP, and thus as we entered the high season, we did not want to attract the group, for we thought that it would displace a lot of rooms in the other hotel and which we could capture and have them at a higher rate than the other group. In June, we increased our premium segment prices as we did not target the group during high season and rather aimed to get the displaced rooms, thus earning higher revenue. Our gamble played off as we made a much higher profit, if not more, than we had in the group in March. RevPAR increased, the market penetration index as well went up, and we were doing better than our competition.
In the second quarter, we improved our MPI and RGI. ADR continues to be low since our prices are lower than the competition. Market share for our target segments, namely guaranteed, large group, and small groups, continue to be higher than 10%. However, bar standards is lower than 10%. Hence, changes need to be made to attract more bar standards guests. Weekend share is less than 10% for our target segments. Market and pricing strategy need to change to attract a better share.
At the start of the quarter, in April, we assessed that we had big enough customer base to implement a loyalty program. We continue to gradually decrease our spending on OTA advertising and increase the direct ones, always keeping the same weekday and weekend ratio.
So, beginning in July, we increased our rates due to the high season kicking in. It complemented our facilities and high quality, since all the refurbishments had been done. However, we were still competitive as our rates were slightly below the average of the market. Contract rates were also increased as they can be altered only at the beginning of the quarter. Since occupancy increased, we changed rate reduction and rate increase to benefit from the higher rates at higher occupancy, greater than 75%. Thus, we increased them to 10 and 5% respectively for weekdays and weekends. Rates were further increased for the peak demand in August. Again, we did not wish to have the group, thus we communicated a higher price for the RFP. Our aim was to capture displaced rooms as the occupancy in general for the market was really high. For the hotel who got the group at higher rates. Since it is a high demand time, there would be greater number of displaced rooms and those rooms we could attract at a greater price than the RFP. Rates did not change as we recorded our highest revenue and profit in August, and we did not see any big change in the market. Revenue decreased in September due to renovations done on the room, thus we had 31 rooms out of order.
We made almost double the GOP in the third quarter compared to the second quarter. This was due to high season and competitive prices, thus maintaining an MPI and an RGI high.
The first month of the quarter, we kept the same marketing and advertising, but then we decided to focus more on our specific target markets. That is why, for marketing, we substantially decreased our spending on OTA advertising, and we also decided to not spend anymore on transient wholesale and group GDS, OTA and wholesale, as all our group requests are booked directly with our hotel. This allowed us to concentrate our spending on our main target markets, which are direct transient, direct groups, and GDS transient. We also based this decision on the fact that in the third quarter of the past year, the new regional tourism promotional budget had generated a record response from tour wholesalers and individuals.
So, through October and November, our rates were kept the same as September. No change required, as the forecasted occupancy was to stay stable, and revenue loss in September was due to the rooms being out of order rather than demand decreasing. We tried not to be the first ones decreasing rates. In November, the revenue improved slightly as we had all 250 rooms operational. The RFP was not in our interest as well because we knew everyone would put lower rates, while we wanted to keep our high rate margin as we had the facilities and refurbishments of higher quality complementing us. Rates slightly decreased in December due to compete with the market as we were entering the low season and everyone was trying to decrease their rates. Thus we decreased the rates slightly, but we still kept above the average.
For the fourth quarter of operation, we kept the same marketing strategy while gradually increasing the spending on advertising and focusing on the chosen target customers.
End of second quarter. First quarter via second quarter, our revenue increased by a big margin and so did our GOP. The percentage for all expenses are lower, but in dollar value they are all increased. The percentage decreased due to our revenue increasing. The third quarter was our best quarter. Compared to the second quarter, we improved our dollar value revenue as well as GOP. The percentage for all expenses lowered further, but in dollar value they increased. The percentage decrease was due to our revenue increasing. In the fourth quarter, we entered low season. Thus, as expected, our revenues and profits were lower than the third quarter. Hence, the percentage for all expenses increased due to lowering of total revenue.
So on average in the first year, our occupancy was at 64%, our ADR was at 168, and our GOP increased to 36.25%. Overall, we managed to attract our target segments, which were large groups, bar standards, and guaranteed. However, by the end of the first quarter, we realized that we should have focused more on small groups, for they brought in more money and they were more consistent, rather than premiums, as we were not able to attract them to our fullest potential.
To summarize our year, at the beginning of the operations, we decided to focus advertising to reintroduce the hotel to the entire market. For marketing, we decided to keep the expenses to the minimum in order to leave more capital for refurbishment. By the end of the year, we had identified and targeted specific markets, and that is where we focused our marketing efforts.
Summary for facility refurbishment and service. Initially, there were two main goals, and that is to elect all the profit-generating services and facilities, and also redo most of the hotel to be ready for high season. But in the first quarter, however, we decided to leave the room alone to see how much revenue we generate without any disturbances. Also, we did not elect many facilities or any premium service due to the fact that our main target are bar standard. Our target market is also a large group, in which we did our best to accommodate them by redoing and cleaning the meeting room right before high season for the segment. However, we didn't, given enough budget, we should also have elected a business center earlier in the year to accommodate them as well. Recommendation. In short term, we recommend our hotel to shift from penetration pricing strategy to skimming strategy per January year 2 to increase ADR index. Also, consider electing an executive lounge to accommodate VIP business guests, and also anticipate current event in the area and change the advertising accordingly. Okay, long-term recommendation, we recommend renovating the standard room to better accommodate guests and to better hotel reputation in the future. Based on the performance of this year, target even more specific customer base.
So for our market indexes, we started off pretty low with our prices and our occupancy being lower than the baseline. But however, we improved with our refurbishment facilities, and we knew we would make a loss in the first few months. In March, we managed to get the group, because of which our occupancy and RevPAR shooted up. But our ADR fell down because the group price were lower than the competition. In April, May, and June, we recovered. However, we did not lose as much as we expected. We still made a profit. However, our indexes were lower than the baseline. Starting July, when we entered the high season and our prices and our marketing strategy coincided, we started making progress. We have a positive occupancy, and our RevPAR for the first time reached more or greater than the baseline in August. Continuing with the end of the year, our occupancy and RevPAR increased. Our ADR was also slightly neutralized, since we made a consistent profit and we did better than the market in terms of occupancy. So in January and February, as stated before, because we focused on refurbishments and it was low season, we made losses. But starting in March, when we got the group with the good RFP, we shooted up with our total revenue, and for the first time we made profits. In April, we lost a bit of our revenue as we did not have the group. Moreover, we had 25 to 31 rooms out of order in April and May due to refurbishments. In June, starting with the high season, we increased our prices, but we still remained competitive. Thus, we can see that we made a higher profit, and the profit kept on increasing with July and August. We did not target the RFP, the group, but rather we were targeting the displaced rooms from the group, from the other hotel, and thus we can see that our profit increased the maximum in August. In September and October, our profits decreased, but this was not due to any change in prices, but this was because our rooms were out of order because of refurbishments. And starting October, November, and December, we still remained positive with a little amount of profit, but it decreased because it was low season. We kept our prices competitive, and thus we still made a profit rather than making a loss.